Welcome to the TAC Index AI podcast, January 15th, 2026, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo.
And today we have a really interesting deep dive. We're looking at the air freight market.
Right, because the big headline is stabilization. But as we'll see, that word is actually masking some extreme regional volatility.
It really is. We're going to try and connect these big price shifts directly to what's happening with global trade, especially with China's export machine and, the health of the U.S. consumer.
Okay, so let's unpack this. The global picture on the surface looks pretty calm.
It does. The Baltic Air Freight Index, the BAI Euro, it barely moved. It was up just 0.6% for the week ending January 12th. So yes, it clawed back a bit of a New Year drop, but
that's totally misleading.
Totally. This isn't stabilization. I think it's more like a regional explosion hidden by an average.
Exactly. The source material is just screaming that. While rates coming out of Asia were pretty much flat, Europe and the Americas bounced back hard.
I mean, just look at London Heathrow. The BAI 40, it jumped, 18.4% week over week? That's a huge move.
A huge move. And Frankfurt, the BAI 20, wasn't far behind, up almost 11%, mostly on higher demand for freight going to the U.S. and Asia.
And you can draw a direct line from that surge to what we're seeing with spending in the U.S.
The K-shaped recovery?
Exactly. U.S. retail sales are resilient, but it's the higher income consumers driving it. They're buying discretionary items, luxury goods, high-end electronics.
Things that have to move by air. They can't wait for a container ship.
Right. And that immediately explains the rebound we're seeing on those transatlantic routes.
And North America followed that trend. Chicago's outbound index, the BAI 50, gained over 10% week over week.
But we have to add some context there. That index is still way down year over year. I think it's off 30%. So a strong week, yes, but it's recovering from a very deep hole.
Okay, so a very different picture than in Asia. Let's talk about Hong Kong. BAI 30, that trended down, right?
It did, down about 6.4%. And the reason there is more operational. Sources are confirming that the annual contract negotiation season is in full swing.
The block space agreements, or BSAs.
That's the one. And that negotiation pressure, it almost always pushes down the spot rates for a little while.
So we have a surge in the West and this sort of technical cool down in Asia. The question is, how does this flat rate picture in Asia square with the just staggering macro news coming out of China?
Yeah, that's the fascinating part. China posted a record $1.19 trillion trade surplus in 2025. Exports were up 5.5%, defying almost every prediction.
But the destination for those exports is changing drastically.
It's a complete redraw of the global logistics map. Exports to the U.S. dropped a lot, 20%, likely because of tariffs. But that volume didn't vanish.
It just shifted.
It just shifted. Surged to Africa, up 26%. To Southeast Asia, up 13%. And to the EU, up over 8%. This is a tectonic plate shift in global trade.
And that puts pressure on European businesses, who face their own hurdles. They've got the 15% duty when they sell to the U.S.
And, this is the part that most people miss, ECB economists estimate the cost of internal EU trade barriers is actually massive. It's like having an internal tariff of somewhere between 60 and 95%.
So fixing your own internal logistics could be more important than worrying about external tariffs.
That's what the analysis suggests. Just reducing those internal costs a tiny bit could completely offset the export losses from U.S. tariffs. It's not always about jet fuel or container rates. Sometimes it's about infrastructure and policy.
So when you put it all together, what does this mean for the market right now?
I think the air cargo market today is really defined by two big things. You have recovering regional prices, driven by that strong, if a bit K-shaped, U.S. demand for high-value goods.
Set against this fundamental long-term shift in global trade routes away from the U.S.
Exactly. And that raises the big provocative question for everyone listening. Given this massive structural export shift away from the U.S. toward Africa and the EU, how is the global logistics network going to adapt its capacity for the long term?
That's the multi-billion-dollar question for every carrier and forwarder out there in 2026.
That certainly is.
Until next time.